A moving average, or MA, is one of the most common tools in many traders' arsenal. There are many uses and people combine different versions of it in their trading strategies, and it's especially useful when the market is trending. What it does is to show you the average values for price over a specified period of time. If we were only looking at the current price, then we would get only a very specific reflection of mass behavior and the overall sentiment. We would not be able then to tell which trend currently takes place. But if on the other hand we were putting together a large number of prices and turn it into one number by using a simple calculation, we would get a much clearer and more precise picture. For instance, a 100 moving average shows you the average price over the past 100 candles. When you connect each day moving average value with the following one, you get a line that indicates where the price currently is in relate to its average. But there is one problem with simple moving average which makes it less effective. The thing is that it works in a way that gives the same level of importance for the current price and the older prices, which are now less relevant. And that creates a situation where the older extreme prices might affect the current values significantly and in a disproportionate way. For example, if the first price was extremely high and now with a new candle the first price is removed from the calculation, the value of the moving average will drop. Again, it will happen because a high price was removed from the calculation. The thing is that this is not relevant to what's happening right now. We can even see a great positive momentum, but the moving average will indicate a decrease because of this extreme level older price. In order to solve this problem, I like to use the exponential moving average, which is a more sophisticated and a much better indication. It's very similar to the simple moving average, only with one important difference. It gives greater importance to the latest candles, so it's not being affected so much by older data. As a result, we get a more relevant data and a line that responds faster to momentum changes. The exponential moving average helps us to trade with the direction of the trend. The most important element is the slope. If it's going up, you want to be on the buying side, and if it goes down, you better be on the selling side. When you choose to add the exponential moving average to your chart, you can change the length in the setting. If you choose 50, for example, it will calculate the last 50 candlesticks, and the same with any other value you put in. So you might ask yourself, what is the setting you should use? But there is no one clear answer to that. In general, the shorter the EMA, the more sensitive to changes it is. So on one end, it could catch new trends early, which is good. But on the other end, it changes direction more often, which makes its signals a bit less reliable. As for longer term EMA, it is more reliable when it provides signals, however it happens less frequent. In addition, it might miss short-term rapid changes in momentum. So there is no one exact value which is correct. It depends on few factors such as the specific currency, time frame of the chart, market conditions, and the trading methods you apply. But in general, if you look for long-term trends, you can use 100 or 200 EMA, and for the short term, use an EMA in the range of 10 to 20. Personally, I like to use the 200 EMA for the long term and 13 for the shorter terms. And in some situations and strategies, you can use multiple moving averages in the same chart, but many times using one and do it properly can be sufficient. Now we will learn a basic EMA strategy. This is a very simple but yet effective strategy based on a 13 exponential moving average. Let's first have a look at the stages and then see how it works on a real chart. First thing you want to do is to add a 13 EMA to your chart. It works well on an hourly chart, but you can use it also on a daily and 15 minutes chart. Then, identify the direction of the price by looking at the slope of the line. You will look to trade from the side of the trend. Place a buy order when the EMA is rising and the price closes slightly above it. It can happen in two scenarios. The first one is when the price comes from below and up across the EMA line. And the second case is when the price is already high above the EMA. In such case, you want it to return toward the EMA line, then once it closes above it, you enter the buying order. That allows you to place a trade with a tight stop loss and a good risk-reward ratio. We will learn about these two terms in the money management section. And the last part is to sell and close your position whenever the price closes below the EMA line. You can also decide to close the trade if you have nice profits and you see signs of trend exhaustion, like weak candles, lower volumes, or other indicators. Now an example. I'm here in the ETH/USD hourly chart and I already added the certain EMA. You know how to add the indicator, and if you want to know how to change its setting, it's very easy. You simply double click on it and make sure the length is set to 13. We start the movement here on the 18th of April and we see this green candle comes from below and closes above the EMA line. Now we could basically enter a trade in one of these candles, but one thing is not optimized. We said that we want to trade with the direction of the trend, and it's not clear here whether the line is actually going up. So in order to be more conservative, we will wait a bit for a confirmation. And we get it soon enough when two things happened. The first one is that the line kept going up and rose above this level where the recent peak was. The second thing that happened is that the price was climbing above the EMA, returned back toward the line, but closed the candle above it. And this, as you remember, was one of our conditions for entering a buy-in order, so we buy at this level in one of these candles. Then, as you can see, the price was going higher, until we had this red candle which closed below the line, and that was the sign to close the trade and get out with a nice profit. Right after that, we had another chance to get in. Once again, the price came from below and closed above the line. This was another entry point which we closed here with some additional profits. I just want to mention that in those two examples we saw very simple entry points that worked great. But obviously it can work also to the downside when the price closes below the line during a downtrend.